Okay, it's 1:02 p.m. Eastern Standard Time, Thursday, June 9th, and this is the NCM Canada webinar. I have with me Keith Leslie, manager of the NCM Core Canadian Fund, and Michael Simpson, manager of the NCM Dividend Champions Fund, formerly known as the NCM Nordic Fund. My name is Alex Sasso. We have a few things on the agenda today. One of which is why Canada, and is it too late to own Canada? Imagine this is an important topic for a lot of advisors that have asset allocation decisions to make. And then we'll continue with our rapid section, our popular rapid fire section, where I'll ask questions of Keith and Michael, expecting short, rapid responses. We'll introduce a new section. It'll be our one-word or two-word answer rapid fire section. So looking forward to that. So thanks everybody, appreciate your time today. We'll try to keep the webinar to around 30 to 40 minutes max. Be respectful of your time. Lots of things to talk about, a lot of different topics today, some of which you will agree with us on and some of which you may or may not agree with us on. But one truth that I think we can all agree upon is that being Canadian is a very good thing. So despite your political affiliations, it's good to have that Canadian passport. We live in a democratic society where, you know, people respect the rule of law. We have a respected political system, very strong financial and banking industry, as well as many other industries. We spend more money per capita on education than any other country on earth, which means our workforce is the best educated workforce anywhere on the planet. And of course, as Canadians, we all have a fundamental right to good quality healthcare. You know, Canada is, you know, one of the largest producers of many different natural resources. Everybody knows that we're strong in the resource game, but not a lot of people know that we're one of the largest producers of gold, nickel, lead, uranium, and of course, petroleum. And after February of 2022, every country on the planet is envious of those that are energy independent. Canada certainly is energy independent. We're not only strong on the natural resource side, we're also one of the largest growers of flax seeds, of canola. We're one of the largest growers of oats, beans, lentils, durum wheat. Wheat is our largest exporting crop. We're one of the top 5 producers of wheat on the planet, and we're the largest producer of high protein wheat. In fact, we were the inventor of high protein wheat. We're fortunate to have the world's largest economy a few miles south of where the majority of our population lives. 73% of our exports go to the U.S. Only 5% go to China, and the next highest on the leaderboard is the U.K. at 4%. And we get 51% of our imports from the U.S., 13% comes from China. Our biggest industry is real estate, followed by manufacturing and natural resource extraction. We're pretty diversified relative to most countries around the world. In fact, we have one of the most technically advanced oil and gas industries anywhere on the planet. We have one of the most productive and efficient agricultural industries in the world. And better yet, the feedstock cost for many of our different industries is amongst the lowest in the world. Take natural gas, for example. Natural gas is used not just in electricity and heating, but we use it for cooking, air conditioning. We use it for many other industrial uses, including plastics, resins, and polymers. And as portfolio managers, we always complain about how cheap the Alberta AECO price is. But imagine the benefits to all the industries that use that natural gas when they're competing against other companies around the world that have significantly higher natural gas. Electricity is another example of Canada's cost advantage. And if you think of, you know, one of the most desirable places to have a business that requires inexpensive electricity, certainly it's Canada. And I'll give you a practical example. imagine if you had a plant based in Michigan and a plant based a few kilometers away in Ontario. That plant in Michigan is going to pay 23 cents a kilowatt hour for electrical costs. You're going to pay roughly half of that in Ontario. In New York, you're going to pay 32 cents a kilowatt hour. In Quebec, you're going to pay almost a quarter of that. And as you guys know, electricity is a cost of almost every business. And that is a sustainable competitive advantage that we have as Canadians. Certainly we punch, it's well known that we punch above our weight when it comes to sports. The Olympic medal count is a case in point, but we also punch above our weight when it comes to business. We have some of the world's biggest companies for a relatively small population. We have some of the world's best quality companies. Think of, the banks and the insurance companies. Those are kind of first that come to mind, but think of Brookfield Asset Management, think of Elemental and Couche-Tard, think of Enbridge, think of Magna, and there's so many others. Our tech industry is pretty strong as well. There are some really exciting tech innovations that are coming along down the pipe. As portfolio managers, we get to see it firsthand. It's pretty exciting to see what's coming. But let's not forget, we're the inventors of the smartphone. We're inventors of the pacemaker. We're inventors of the zero emission, no noise electric automobile. That's pretty impressive, again, for a population of 38 million people. And as I said, as portfolio managers, we are the capital providers to some of these new ideas. We get to see these, and we're pretty excited about some of the stuff we see coming down the pipe. But I'll say that the most impressive invention coming out of Canada was the Hawaiian pizza. And they call it Hawaiian, but really isn't Hawaiian. It was invented in Chatham, Ontario, ladies and gentlemen. Yes, the Hawaiian pizza is actually Canadian, and pineapples do belong on a pizza. All kidding aside, we're fortunate at NCM. We have really strong Canadian-focused mandates. Case in point would be the NCM Income Growth Fund, which I manage. It's a all-cap dividend-focused fund, 4% dividend yield. It's in the equity balanced category, and what that means is that a small percentage of the fund is invested in fixed income instruments. On the fixed income side, we use that as the ballast of the fund. It's usually around 10% of the fund. It has to have a minimum of 10% fixed income. And the reason is we believe that we can generate better alpha and stronger dividends and dividend growth from the equity portion of the portfolio. Very strong long-term track record, one of the best in its categories. And then those dividends that it distributes to unit holders, it's roughly 4%, 4 and change percent per year. Those are tax advantaged dividends because one, they're 100% Canadian eligible dividends, as every name is Canadian. And secondly, is we use the expenses of the corporation to offset some of the interest income that the fund generates. I'm going to pass it to Keith and then to Mike to talk just briefly about their two mandates, and then we'll jump into some questions that I have for these two fine portfolio managers.
Thanks, Alex. Guess we'll just give a quick update or a review of what the Core Canadian does. Core Canadian is a low volatility, high active share, large cap Canadian equity fund. So everyone knows it falls under the CIFSC Canadian equity category, which means it's got to be 90% in Canada, at least. We've taken it a little bit different for asset mix reasons, and we've committed to be 100% trading on Canadian exchanges all the time, so 100% Canadian. It's a straightforward asset class, but with our high active share, we do not look anything like the index. I've been the lead manager on the fund since its inception, and I've been with NCM since its infancy in 2001, so just over 20 years. I guess we'll pass it on to Mike now to give a quick review of Dividend Champions.
Thanks, Keith. The NCM Dividend Champions really has its roots in the NORP Fund. When I came aboard and when the fund went through a unit holders vote to change the mandate to more of a North American dividend paying, dividend champion focus group of companies, our mandate is we have to be minimum 51% in Canada, maximum 49% outside of Canada. The outside of Canada is exclusively in the US. Right now, I have a weighting of about 23% in the US. The question may be why? And the answer quite simply is because I see better opportunities in Canada than in the US. So we look at a North American centric model. Great Canadian companies can trade with their largest trading partner in north-south flows. And we look to invest in great quality companies, dividend champions, as we call them. And the fund currently pays a 7-cent per month distribution.
Awesome. Thank you, gentlemen. Keith, Mike, let's get into it with some current topics that many advisors are going to be interested in knowing. Again, a reminder to keep your answers relatively short. We're kind of tight on time. If the audience wants a more fulsome answer to any of these topics, please reach out to your regional salesperson at sales@ncminvestments.com, and we'll do our best to elaborate on the topic. Mike, why don't I start with you? As you mentioned, you're overweight Canada right now. The nice thing about your mandate is that you can move between Canada and the US. Maybe just provide the audience a bit more of a fulsome answer on why you're overweight Canada.
It really is because of where we are in the economic cycle. We went through a pandemic. We went through quite strong growth. Now the growth is moderating, but we still have high inflation. So Canada has a collection of great companies, also known as that are more in the hard asset space. So they have the ability to benefit from rising commodity prices. They have the ability internally to deal with inflation. And of course, naturally, they have the ability to not only pay dividends, but to raise their dividends in any type of economic environment. That's why I have more of a focus to Canada right now, Alex.
Yeah, no, that's a great answer, and I fully concur with it. In fact, what we're seeing in Canada is we're seeing a better earnings growth, faster earnings growth. In fact, I have a slide now. If we can put up slide number 2, please. So what we're showing you here is this is the TSX and the S&P 500 earnings growth index back to the pandemic, February of 2020. And the gray line there is the growth of TSX forward earnings, 12-month forward earnings versus the blue line, the S&P 500. And I think this chart will surprise a lot of people, but as you can see, Canada post the pandemic has been growing at a much more rapid clip than the US. Despite this, Canada still trades at a significant discount. And if we can go to slide number 3, please. And despite the faster growth in Canada, you can see the multiple spread here between Canada and the US. And this spread is significantly higher than we've seen over many of the last few decades. What we're showing you here is price earnings multiple based on 12-month forward operating earnings. That blue line is the TSX. You can see that the forward operating earnings is a low 12.7, significantly different to the right of the graph of the S&P 500, where it's still relatively high, 16.9. The point being, in Canada, you get faster growth and you get a much less expensive market to choose from. So those are a couple additional points that I would just highlight, Mike. To your point about overweighting Canada, Keith, I had a follow-up question for you. I think we all know that, at least from a reputation point of view, it's been better to be in the US the last few years relative to Canada. From your work, as a mathematician and somebody that spends a lot of their time looking at important statistics to try to give us a better lens on what's going to happen. If you're looking at these numbers a bit longer dated, does that change the perception that the US is the best place to invest?
Thanks, Alex. Yeah, it's interesting. If you go back to a longer time period, say 20 years, The investing landscape is quite different from the last 10. There's no doubt the US market's been the place to be over the last 10 years. But if we can put up chart 4 or slide 4, I think you'll find a surprise. You'd be very surprised to see that over a 20-year time period, the TSX and the S&P 500 in Canadian dollar terms are essentially the same. You know, the last 12 months, I think we all know that Canada's been strong, and certainly year to date, you can see the significant difference. Again, if you look at the 10-year number, the S&P 500 in Canadian dollars is significantly stronger, but there certainly is a catch-up trade in the 10 years before that. What I decided to do is, well, first I understand that the asset classes have trended and outperformance has continued for periods of time. It's typically not a one-year phenomena. And if I go back over the last 20 years and assume that, or 19 years and assume 2022 to be a full year, I think it would shock a lot of people to realize Canada has been the best major asset class 40% of the time. The S&P 500 only 35% of the time. Not only, but it's slightly less at 35. International markets 15% of the time, and the Canada bond universe 10%. So for me, the bottom line is an investor's asset mix or optimal asset mix should include Canada. And I think we could be at the beginning of a lengthier period of Canadian relative outperformance. Everything looks good. The Canadian market is trending, and I think we'll get into a little bit later. But again, the big shocker on this one is the 20-year return. I don't think most people would expect that the 20-year return is very similar between Canada and the US.
Yeah, no, that's a great point, and certainly worthy of a Trivial Pursuit question in the future, Keith. Mike, some of that recent performance has come via the energy patch. Is the ironclad rule of supply and demand taking hold here, or do you think perhaps a ceasefire will put the nail in the oil and gas coffin?
Sure. If you bring up slide 10, Alex, but the first rule of economics is supply and demand. So coming out of the pandemic, we have more demand for energy. We still have a rising world population. So it's not only about Russia. The U.S. is the world's largest producer of oil. What we have is a tight situation over the last 10 to 12 years for numerous reasons, which I won't get into now. Oil companies have underinvested in finding new reserves. So as a result of the move away from carbon, right now we're in a very tight situation with spare capacity, even producing from existing reserves and fields. So it's not too late. Energy companies are disciplined. They're generating copious amounts of free cash flow, buying back shares, paying dividends, paying specials, and raising their dividend. So I have a good weighting in energy, and it's all Canadian. And there's some great Canadian energy companies, Alex.
Yeah, and Mike, what we're seeing, worldwide is just this massive dislocation of energy supply lines, where Europe used to get, the vast majority of its energy resources from Russia. That's all being rerouted now, and so you have certainly geopolitical issues, you have dislocation issues, and then you've got really disciplined oil and gas management teams that aren't spending 150% of their cash flows like they have been in previous cycles, trying to shore up their balance sheet with equity issues. So one of the issues that I have with the patch is that valuations are very, very low, and so the market looks at that and says, we're not willing to put big multiples on this thing because we're worried about the long-term supply and demand fundamentals, and what's gonna happen with the electrification of vehicles and things like that. But I think for the foreseeable future, I think the outlook looks quite strong for the industry, despite those low multiples. But speaking of low multiples and the lowering of multiples, Keith, I had a question for you just on the we're seeing contracting multiples in the market most recently as a longtime observer of the markets from a quantitative perspective. What do you think those numbers are telling you? Is this a concern, or could this be an opportunity for the market?
You know what? I think the best way to answer that question is in a picture. So we can pull up slide 5. So what this chart is showing here is it's showing the TSX earnings over time and the PE multiple. If we're going back to 1995, and of course the 2022 number is an estimate. What you can see here is that the earnings are at all-time high. So the TSX earnings are at all-time highs, and yet the multiple is near an all-time low, pretty close to where it was in 2008. So, you know, real simple answer from my point of view, I think from anyone's point of view, low multiples and all-time high earnings is a great combination. Add in the strong momentum of the Canadian market, and I really view this as an opportunity. The other thing I'd bring up is when people think of the Canadian market, they do think that it's an energy market. The energy weight on the TSX is about 17%, but only 10% of that is in energy producers. So it is not just an energy market. I think there are other opportunities, and as Alex said earlier, other great companies on the TSX.
Yeah, there's so many great businesses. We got 3,000 different businesses to choose from here, many which are robust dividend payers that don't have the high payout ratios that they used to have in previous cycles. My argument is that many of these dividend payers are better companies and should be more consistent paying companies than they have been in the past. You know, Mike, we've heard a lot about global growth decelerating. OECD came out the other day and I think yesterday and said, you know, they're lowering their growth forecast globally. In your opinion, can Canada outperform in a slowing global economy?
Yes, Alex, if you would go to slide 8, this slide basically shows when earnings slow, the type of companies that perform the best are those dividend paying stocks, and also those companies that consistently raise their dividend. So again, we have this combination of slowing growth, but let's call it persistent inflation. And as a result, Canada specializes in companies that extract or obtain some value from the commodity cycle, call them second derivative plays. So absolutely, Canada can benefit. Canadian economy is quite strong. As the Bank of Canada governor mentioned, there's 1 million job vacancies that need workers. So in this environment where you still have inflation but growth slows, Canadian companies, in particular Canadian dividend paying and the dividend champion companies, can still be very successful.
Yeah, good point. And you know, one of the really pressing topics is, of course, inflation. Inflation not just affects Bay Street and Wall Street, but inflation affects Main Street, and that's the concern. And as we all know, the consumer is a majority of each economy's GDP. But Keith, I had a question for you regarding inflation and how rampant it is around the world. So curious to see, you know, at this point of the market cycle, what factors do you see in your work that might help with the wealth destruction that inflation brings portfolios?
I think Mike started touching on it a little bit here, and really one of the most important factors for me at this point in the cycle is dividends, or more specifically, increasing dividends. Historically, dividends have made up a significant portion of the return of the TSX. So companies that are increasing their dividends are certainly have always been very attractive, a little more so now. Typically, companies that are increasing their dividends, they're doing that when their debt levels are under control, their prospects look good, And basically they have stable, continued growth. Of course, we want to make sure that we couple that with reasonable payout ratios so we don't get dividend cuts in the future. In the NCM Core Canadian, over 90% of the names pay a dividend. The internal yield's 3.1%, and most importantly, it's about a 10% increase, just under 10% increase over the past year. Dividend paying securities are definitely on my radar right now, and even more so than usual.
Yeah, and I agree with that. And I think dividends are the best inflation busters that we have. And, dividends, frankly, have underperformed in 2020 and 2021, which is kind of unusual. Typically, over a business cycle, they tend to be great performers and a big chunk of the total return equation. I think go forward, they become a bigger and bigger part of that total return equation. In fact, I have a slide on dividends. If we could punch it up, I think it's slide number 7. I just want to highlight this because I think it's important. So we're believers that you're going to start seeing dividends per share. Dividend companies start paying a bigger percentage of their free cash flow out in dividends. And what the blue line there is showing you is that's earnings per share growth. And then that gray line is the last 12 months dividend per share growth. And you can see that there is a correlation between the two. When you have earnings growth, you typically have shortly thereafter dividend per share growth. We've seen it up until just recently, given what happened in 2020 and 2021. Managers are being a little bit more conservative. I think they're feeling better today in 2022. Their outlook is fairly robust. And so you're going to start seeing more and more companies paying shareholders back via dividends. So I certainly concur with what you're saying there, Keith. Mike, over to you. Rates, we've seen Bank of Canada raise 50, guide potentially to 75. We've seen the Fed raise. And then just a couple of days ago, Bank of Australia raised rates. Just curious, you've been in the industry for a long time. Can Canada or can equities outperform in a rising interest rate environment?
Yeah, if you look to slide 1, if you bring that up, that in essence talks about free cash flow yield. So, we talked about dividends, but it's important to get to the start of where dividends come from. So companies generate cash flow from operation. Then we at NCM, we need to take out any cash taxes, any cash interest, and also importantly, any cash or any CapEx to maintain the business. So as you can see, that free cash flow yield is poised to grow, given the unique qualities of our economy, and given that we think there's a record amount of debt held by consumers and businesses in Canada, and people may not like it, but there's a base effect to the CPI calculation. So as inflation gets down to 3.5–4%, we think that will slow the pace of Bank of Canada increases. So equities can still do well, but you have to be in equities that have exposure to hard assets, equities that pay dividends and grow their dividends. So absolutely, now's not the time to abandon ship, but to invest rather at a discounted valuation.
And that's always been at the heart of NCM's investment methodology, is combining very strong quantitative analysis with the roll up your sleeves fundamental work, and the combination of the two increases your probability of outperforming. With that said, let's very quickly transition to the rapid fire section here, gentlemen. So thanks for your more fulsome answers. We'll ask for more answers for this section. Keith, your portfolio have always had phenomenal attributes, very low valuation metrics, but very strong growth metrics. In fact, it's probably some of the best attributes of any investment product in Canada. Given your experience with these great attributes, maybe if you can just highlight for us one attribute that you really put a lot of emphasis in.
Alex, I'm not really good at just giving you one, so I got to look at two in combination because I think valuation and growth are what's important. Really, right now, the fund trades at 10.3 times forward earnings, and we have expected EPS growth of 37%. I don't think you need to go too much further than that. Those attributes look fantastic right now.
Yeah, that's good. And speaking of good attributes, Mike, you often talk about acorns. Maybe just give us one of your acorns.
Sure. It comes out of the great province of Saskatchewan. It's a company that will be trading in about 2 weeks. It's called Global Food and Ingredients. I guess in my past work career, I made a lot of money with a great entrepreneur, Murad, with AGT, Alliance Grain Traders. So this is a company that buys peas and lentils. We were talking about earlier about food security. So this is a company that's in the growing food space of plant protein that are both for human consumption and animal consumption. We all want to eat healthier. So I think this is a great company. And I think it's got a great runway, and it's right here in Canada, Western Canada. So I'm very excited about the prospects for Global Food and Ingredients.
Keith, company A, company B, exact same business, exact same products. What attributes are you looking for as a portfolio manager to differentiate one from the other?
Historically, there's really been two factors that have been added a ton of value. Believe it or not, one of the best factors over time is actually 9-month price change. Buy the stock that's gone up the most over the last 9 months. So it is something we look at. We do want to see stocks hitting new highs. But more importantly, from a fundamental point of view, I'm looking for an accelerating ROE. So comparing this coming year's ROE to last year's and seeing an acceleration in that, I think that leads to greater long-term profitability.
I fully agree with you. And what I'll tell many of the advisors out there, that rate of change of many of the important variables or stats on a company are really critical. You can have a growing business, but if it's a decelerating growth, the market will look at that a lot more skeptically than an accelerating growth. So the second derivative, the rate of change, is key. So fully agree with you. Mike, C dollar, US dollar, you're managing a fund that can invest in both. Your thoughts on the C dollar as we head towards the back half of the year? You're on mute, Mike.
Sorry about that. I do hedge. I hedge every month. It's a 1-month rolling forward hedge. So given the strength in commodities, don't know when oil will reach a plateau, but I think marginally to the end of the year is the basis of your question. I believe the Canadian dollar can be marginally higher, perhaps 2-3%. But just for the audience, I do hedge every month. It's a 1-month forward, and I could hedge anywhere from 35 to 50%. So right now I'm 50% hedged. So the philosophy with hedging at the NCM Dividend Champions is not to make big bets, but just to protect against the downside. And that's what we do consistently every month at NCM.
Mike, I'm going to stick with you. You mentioned Dividend Champions. We recently changed the name. Maybe just give the audience the reason for the name change.
Yeah, the name change reflects that the roots of the NORP fund, very good, very successful, but it was more small mid-cap companies. So the NCM Dividend Champions, primarily large cap, although I have the ability to buy some mid and small caps. The small caps we call acorns just because we want to distinguish, differentiate, and also build on my work of many years running a small cap fund. So it's a North American focused fund. I like Canadian companies. I like to supplement or complement my great Canadian companies with industries or companies we don't have in Canada. So that's the general philosophy. And as we pointed out earlier, I don't have to rehash it, but valuations are better in Canada. And that's why I have a higher weighting to Canada right now.
Mike, you were my biggest competitor when you were doing small cap work at your former firm, and much happier to have you on the team than to be going to be competing with you. So it's been great for the last year and a bit working with you. I've learned a lot. Keith, maybe just one of your top quant names.
Alex, as I said last time, I don't like sticking to one, so I'll just give you two real quick. First of all, a company that is a little bit higher beta name but is Gildan Activewear. They were beating every quarter. It's trading at 10 times earnings. It's certainly one that I think is poised for a breakout. From a lower vol, given we're a low vol fund, Loblaws is boring, but I really like Loblaws. It's expected growth, and frankly, boring is good sometimes.
Well, it's getting a bigger and bigger share of my wallet. I'll tell you that. That is Loblaws. Granite REIT. And just looking through your portfolio, Mike, Granite REIT is your biggest position. Maybe just a quick blurb on why.
Sure. Granite REIT was spun out from the old Magna real estate assets. Granite has industrial. It's an industrial warehouse REIT, properties in Canada, the U.S., and Europe. Great management. Also among the REITs, it leads in its low leverage, which is good, low payout ratio. So it has the ability to keep on growing. Contrary to what people think, even though there's been a slowdown in Amazon orders or Shopify orders, e-commerce is not going away. Canadian retail sales and e-commerce lag US and Europe. So if you talk to any business owner, it's very difficult and expensive to get industrial warehouse space in the 6 or 7 major urban markets in Canada. So we like this. Early in the year, there was some M&A activity around industrial spaces. So great management, great potential for more dividend growth, and very good hard assets that are retaining their value in some very pricey, expensive markets.
I'd add on top of that, it's a very high quality management team amongst the REITs. I'd characterize them as one of the better management teams. Keith, over to you. I'm looking through your portfolio. One of your biggest names is Pet Value. Maybe just a quick blurb on Pet Value.
Sure. During the pandemic, the number of households with pets increased significantly. And, Pet Value just doesn't sell food and toys. They offer dog washing, grooming, teeth cleaning. And just from a personal point of view, it took us 3 months calling every Pet Value to get my dog's teeth cleaned. We called every Pet Value in the Calgary area, and we're still 3 months out. I kind of like when they're that full. Really expected growth of 50% over the next 2 years. And it's really underfollowed and underowned. And it's certainly, while we're a large cap fund, we do participate in some smaller cap names. And this is one I think is pretty exciting going forward.
The last quarter was a very strong quarter. Those same store sales growth were really, really impressive. All right, we don't have a lot of time left, guys. So let's transition to the 1 or 2 word answer rapid fire section. I'll just fire away with a few topics du jour. Maybe Keith, I'll start with you. Estimate revisions, we see them. Do you see them coming down this year?
Yes, they always go down. Analysts are most optimistic at the beginning.
Yeah, 8 out of 10 years they do. I think it's more normal. Last couple of years we've had upward analyst estimate revisions as we went into the back half of the year. So I don't think that's anything that's going to spook the market. Mike, yield curve, does it invert this year?
Well, sections of it have already inverted, and in Canada, the 10 to 30 is already inverted. So I would say that's your answer. So parts of it, the whole yield curve, probably not, but parts have already inverted.
Is it a false signal like it was a couple of years ago?
It's an unreliable signal, and work I've done is once it happens, it has to be sustained, and then you have to look for the result usually 11 to 13 months in the future. So those are just things to consider.
Mike, I'll stick with you. Goods inflation. So when I look at inflation, I separate goods inflation from services inflation. Goods inflation has peaked. We've started to see it drop. We've got services inflation happening now. Does it follow a similar pattern as goods inflation?
Yes, with the exception of some very limited services, but it does follow the pattern of goods. If there's less impetus, less goods inflation, that will spill over into the services side.
Keith, company A, company B, similar company, similar industry. One has really good cash flow growth. One has a very strong free cash flow yield. What do you prefer, company A or company B, all else equal?
free cash flow yield.
It's been a better predictor long term. I saw a report by Morgan Stanley recently, basically saying just that. So yeah, I tend to agree with you, Keith. I'll stick with you. Wheat stocks. You know, they were a fan favorite for a couple of years. They've kind of died away here. Do you see a resurgence happening?
No.
Love it, Mike. Blue Jays make the playoffs this year?
Absolutely, yes.
Keith, do the Calgary Flames make the playoffs next year?
Of course.
Mike, 25 or 50 or a different number from the Fed this year?
Well, the next meeting.
This month.
Next meeting will be 50 basis points.
I think it'll be 50. Okay.
Yes.
All right. Last name you put into the fund, Keith?
Spartan Delta. Increase my energy exposure.
Okay, Mike, last name you put into the fund?
I bought some more Transforce. It was getting beaten up, and there's great restructurings they can get from buying the UPS assets down in the U.S.
All right, and then the last question, because we're coming up on 43 minutes here. You know, Canada has made, the Canadian men's soccer team has made the finals. Has made the World Cup. I'm predicting that they're going to make it all the way to the finals. Mike, I'm kind of curious, you know, how many goals do they win by in the World Cup finals?
1 goal, Alex.
It's always 1 goal. It's always 1 goal. All right. Thanks. Thanks, everybody. I really appreciate your thoughts, Keith and Mike. Really appreciate everybody for listening. Again, happy to elaborate on any of these really sensitive and important topics, especially for you advisors out there that have difficult asset allocation decisions to make. As always, contact your regional NCM salesperson at NCM Sales. You can visit our website, you can call them directly, or you can send them a email. So with that, thank you, everybody. Appreciate it, and we'll be in touch.
Thanks, Alex.
Thank you.